Hello, this is Christopher. I want to talk to you today about charting patterns and using an example that happened earlier this morning on the Euro-Japanese yen that shows how the market reacts against certain price levels using certain indicators that are very easy to use and are very popular. That's the reason the market reacts around them, because so many people are using these price levels at the same time. And if you learned how to use these price levels like they learn the price levels, like the big boys and girls who trade, like they use the price levels, then we can kind of, as smaller traders, hang on to their coattails and ride the money wave with them. So I want to look at an example that I saw earlier today. What I've got up here on the chart right now is the Euro-Japanese yen. I'm looking at the 1 hour time frame. My red line right here indicates when trading started for this week. Now this is Monday evening in the US where I am at. So trading has been open for about 24 hours, a little over this week. This is the first bar of trading for the beginning of this week that started Sunday evening where I am in the US. These lines right here, specifically this red line, is what's called a pivot point. Now pivot points are used by all types of people. They're very easy to calculate. And I've even created a video that I've placed on the blog that will teach you how to calculate and mark pivot points onto your own Forex charting. So what I've got here is just called the pivot point. This red one is the midpoint. Here's a support level for the pivot points. Here's a resistance level for the pivot points. So like I said, these can be easily calculated. Every week I calculate these pivot points before I begin next week's trading. I'm also going to add something called Fibonacci. Now Fibonacci levels are basic levels found in nature, if you will. You can do some research in Google and learn a little bit about Fibonacci levels. Again, Fibonacci levels are also used by the big boys and girls who trade. We want to use what they use, and because we want to see the market the way they see it. Fibonacci levels can be created just by simply drawing, just as I did, levels from the a high to a low segment. And here are the Fibonacci levels. Here's a 0, a 23.6, 38.2, 50, 61.8. Okay, you look at those and say, well, those are rather arbitrary, but there is some math reasons behind why those levels are selected. And do a little research on Google. It's fairly simple to understand. One thing I did notice immediately when I drew this Fibonacci level, though, is this. Notice this 61.8 line, how close it is to this midpoint line. Okay, 61.8 and this midpoint. They're very close to each other, actually within about 10 pips. When you see two separate indicators or price levels that are very close to each other, we call that confluence. And all that means is you've got two or more indicators that identify a certain price as a possible turning point. When you see two or more indicators identifying the same price as a possible turning point, that will probably be a very strong turning point in the market. If price goes down to those levels and then turns direction and goes back up, well, that was a very strong level. Even if price goes right through those two levels and pays no attention to it as if they weren't even there, you can bet there were a lot of people looking at those levels, and the market was just so much stronger than those levels, which indicates, look, the market is really strong going in that direction. So when you see two price points like this fairly close to each other, you can make a bet that something's going to happen around them. Again, I'll point this out. Here's the weekly midpoint. Here's the 61.8 line on the Fibonacci level right beside each other. Let me scroll to where trading started for this week. Alright, here's the first bar of trading right here. Now I'm not going to keep us in suspense because I really don't want this to be seeing this chart candlestick by candlestick. So I'm just going to go ahead and drag this over and let's see how it reacted. As you can see, right here, 1 hour after trading started, the price fell and hit this 61.8 Fibonacci level to the very pip. To the very pip, this Fibonacci level was hit, and the market retraced, turned around, and went all the way back up. Like I said, when you see two levels like this, the weekly midpoint is 125.44. The 61.8 line is 125.52, less than 10 pips apart. When you see that, you've got to pay attention. And as you can see, the market came down to this level, turned around, and went right back up. All that means is there were other people watching these levels too, and when the market hit it, they said now is a great time to buy, and buy they did, and up went the price. Not only do you see that, but you can also see right here how close the price came to the first resistance level of the pivot points before it fell. Let's see, the high of this bar right here is 128.72, and as you can see, 128.77 is the level for the first resistance. So the price came within 5 pips of the first resistance level on the pivot point and then turned around and fell down. It just goes to show that these indicators are not just random indicators. They're there for a purpose, and many people use them, including the big banks, the major corporations, people that trade with a lot of money. They know what these levels are, and they trade with them. And that is why the price gets so close to these levels and the market reacts around these levels so very well. So I hope you enjoyed this. I'll try to do more videos of this very often. By looking in hindsight, sure, I didn't make money off of either of these trades because I didn't take them, but by looking at hindsight and seeing how the market reacted around certain levels, it gives us a clue on how to trade when we see these patterns in the future.